Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools and liquidity tools as opposed to more traditional monetary policy tools and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient and well-positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools: monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, the discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.